You have 800,000 baht sitting in a Thai bank account. You seasoned it for 3 months. You showed up at immigration with every document they asked for, and they denied your extension anyway. Because 47 days earlier, your balance had dipped to 380,000 baht to cover a hospital bill. Nobody told you the 800,000 isn't a target you hit once a year. It's a floor you cannot touch, ever. And that one hospital bill just cost you your retirement in Thailand. There are 7 rules buried inside Thailand's retirement visa system exactly like that one. Most retirees discover them the hard way. This video is going to show you all of them before that happens. Let's start with a number that defines whether this matters to you at all. Thailand has roughly 50,000 registered foreign retirees holding long-stay visas. The actual number living here on retirement extensions, including those who entered on tourist exemptions and extended in-country, is meaningfully higher. Every single one of them is living inside a compliance system that has 2 entirely different sets of rules, depending on one decision they almost certainly made without realizing it mattered. 800,000 baht. That's the number every retiree knows. It sits in your Bangkok bank account. It earns a little interest, and once a year you walk into immigration and prove it's there. That's the deal, or so most people think. Here's what the deal actually is. The 800,000 has 3 separate compliance triggers, not one. First, your balance cannot fall below 400,000 baht at any single moment during the entire visa year. Not on average, not on the day immigration checks, at any moment. One day below that floor, and the Thai immigration system considers your financial proof void for that period. Second, the full 800,000 must be sitting in the account for at least 3 months, roughly 90 days, before your annual extension application date. Not the day before, 90 days before. Third, the account must be in your sole name. Joint accounts do not qualify under any circumstances. If you're the kind of retiree who dips into savings for a medical bill, a holiday flight home, or a family emergency, and then tops it back up before extension day, you have almost certainly been in technical violation of your visa conditions without knowing it. The immigration officer who stamped your last extension didn't check your 12 months of bank statements. The next one might. That's the deposit side. Now let's talk about the side that actually splits the retirement visa world in 2. Picture 2 British retirees, both 68 years old, both living in Chiang Mai, both holding what they call their retirement visa. Both have exactly 800,000 baht in a Bangkok bank account. One applied for his non-OA at the Thai consulate in London before he flew out. The other entered on a 30-day tourist exemption, walked into the Chiang Mai immigration office and extended her non-O for retirement purposes in-country. Same city, same deposit, same annual reporting obligations, completely different insurance obligations. The man on the non-OA is legally required to hold health insurance, meeting minimum coverage of 40,000 baht outpatient and 400,000 baht inpatient, at initial application and at every single annual extension for as long as he lives in Thailand. At 68, with a pre-existing condition flagged in his medical history, his annual premium has just crossed 112,000 baht. That's 9,300 baht every month just to maintain the legal right to stay. And the premium climbs every birthday, whether he uses the insurance or not. The woman on the non-O retirement extension, her mandatory insurance requirement is 0 baht. As of early 2026, the in-country extension route carries no statutory health insurance obligation. She holds a foreign travel policy she chose herself. It costs her 35,000 baht a year. She keeps it because she wants it, not because immigration demands it.
Over 10 years, that gap compounds. The non-OA holder at 68, with premiums rising at roughly 8% annually, will spend somewhere between 1 and 1.4 million baht on mandatory insurance alone over the next decade. The non-O holder, identical in every other way, spends whatever she chooses, or nothing at all. The difference is not health. It is not nationality. It is which desk they sat at on day 1. So how does the non-O route actually work mechanically? You enter Thailand either on a 30-day visa-exempt stamp, what most people call the tourist exemption, or on a 90-day non-O visa obtained at a Thai consulate abroad. Once in country, you visit your local immigration office and apply for a 1-year extension of stay for retirement purposes. You present the same 800,000 baht deposit evidence. You get the same 1-year stamp. You carry out the same 90-day reporting throughout the year. The functional outcome, a 1-year retirement extension, is identical. The compliance burden is not. One important caveat here, and it matters. Individual immigration offices across Thailand have started applying their own interpretations of the insurance requirement. Some offices, particularly in tourist-heavy provinces, have begun requesting insurance evidence from non-O extension applicants who are not technically required to provide it. This inconsistency is real and documented. It means the non-O insurance advantage is structurally correct, but practically variable, depending on where you live in Thailand and which officer processes your application. If you're on a non-O retirement extension and an immigration officer asks for insurance documentation they're not entitled to require, you have the right to decline, politely, with documentation of the regulatory position. Most experienced expats carry a printed copy of the relevant immigration circular alongside their extension paperwork precisely for this reason. There is a third financial proof method worth addressing briefly, the income method. Thailand's retirement extension rules allow you to demonstrate 65,000 baht per month in verifiable foreign income in lieu of the 800,000 deposit. In theory. In practice, this method has become nearly impossible to execute cleanly. Thai banks will not issue the income certification letter this method requires unless they can directly verify the income source, and most foreign pension and investment income cannot be verified to Thai banking standards. The deposit method remains, by significant margin, the most reliable path for the overwhelming majority of retirees. There is also a combination method, partial deposit plus partial income, but it carries the same certification problem for the income component and adds complexity without meaningfully reducing the cash tied up in the Thai account. So what does this actually look like in practice for someone making this decision today? If you're planning to retire to Thailand and haven't yet entered the country, the non-O route gives you structural flexibility, particularly on insurance, that the non-OA does not. Enter on a tourist exemption or a short-stay non-O, extend in country, and you retain the choice of whether to hold insurance, what kind and at what cost. If you're already on a non-OA and past the point of switching cleanly, the insurance obligation is real and ongoing. Budget for it. Model the premium trajectory. At 65 with clean health, you're likely paying somewhere between 50,000 and 75,000 baht annually today. By 75, if you're still in Thailand, that number will be materially higher, and some policies exclude pre-existing conditions that develop after initial underwriting. Regardless of which route you're on, the 800,000 baht floor management is non-negotiable. Open a dedicated sole name account at a Thai bank. Do not use it for daily expenses. Treat the 400,000 baht floor as a hard wall, not a guideline. And build your 90-day pre-extension seasoning period into your calendar 12 months in advance, not 3 months in advance. The retirement visa isn't complicated, but it is precise. And precision in a system with real deportation consequences is not optional.
The 800,000 BAT number you know. The 400,000 BAT floor that runs every day of the year. That's the one that catches people. The insurance split between non-OA and non-O, that's the one that costs people 100,000 BAT a year without them realizing they ever had a choice. Know which visa you're on. Know what it actually requires. And if you're about to make the decision for the first time, make it with both sets of rules in front of you, not just the deposit number. For the full compliance checklist, Immigration Office Insurance Enforcement Tracker, and a breakdown of every Thai bank's seasoning account options, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com or subscribe to this channel so you don't miss what comes next.